Time now for a very special interview with New York Fed President John Williams. For that, we want to head over to Steve Liesman. Mr. Liesman.
Andrew, thanks very much. I am here at the New York Federal Reserve Bank with New York Fed President John Williams. And I want to make a note to viewers that obviously there's a lot of things happening with the Federal Reserve. These things are scheduled pretty well in advance. So, John, thanks for joining us.
Steve, welcome back to the New York Fed.
Yes, it's always great to be in these incredible hallways here. Let me begin with the news of the day, which is that the president, for the first time in history, has fired a governor of the Federal Reserve Board for cause. I want your reaction to the president's actions and your reaction to the allegations against Fed Governor Lisa Cook.
Well, I don't have anything to add or say around and the allegations. Obviously, that's a legal process. I'll let others speak to that. Personally, I have worked with Lisa Cook as she's been a member of the Board of Governors, and she's always brought, integrity and a commitment to the Federal Reserve's mission. She's a very esteemed and highly respected economist. But I think the broader picture, obviously, is that, I think Federal Reserve central bank independence is very much very important. It's important not because it's convenient or anything like that, but because we know from history, from experience, that independent central banks can deliver low inflation, economic and financial stability. And we know the structure of the Federal Reserve is such that it's designed to have independent policymakers who are making decisions that affect the economy over the longer term, away from short-term political pressure. And I think that's really, really important.
But if the president can fire somebody based upon allegations, does that threaten the Fed's independence?
Well, again, I'm going to just speak to the importance of the independence and something that, I think is proven to be valuable around the world. We see countries throughout all the continents really have turned to having independent central banks like we do, so that you can get the best outcomes for the people of the country and in our case, for the United States and quite honestly, for the world. The Federal Reserve is obviously very central to the health of the U.S. economy and the global economy.
So one more question on this topic. There's this one issue that seems to come up, which is the issue of Fed independence and the president perhaps threatening that with these by firing Federal Reserve Board of Governors. On the other hand, there are the charges. The idea that the Fed Governor Lisa Cook might indeed have committed mortgage fraud. How serious is that?
Well, again, on these accusations, I don't have anything to say to that or add to that. I think really that's a process that's underway and should talk to the people involved in that.
Move on now, John, to your outlook for the economy. GDP has slowed. Payroll growth has slowed. How much concern do you have that the economy is weakening or softening here?
Well, it's absolutely true. GDP growth has slowed in the first half of the year, roughly 1.25% growth at an annual rate relative to about 2.5% last year. My expectation is that's going to continue through this year, but that's a slowing economy. It's not a stalling economy. We look at a broad set of indicators. I think we're seeing kind of an economy going through an adjustment process, partly the continuing adjustment from post-pandemic, partly an adjustment to some of the policy changes that have happened, including trade policy. So I see that as something that's been ongoing. I'm watching very carefully, watching all the indicators in the labor market, spending. So my view is the economy is growing, will continue to grow. For the year as a whole, maybe 1 to 1.5% annual rate, a little bit, like I said, a little bit slower than last year, but still positive momentum going forward. But I'm watching that data very carefully.
You had described the job market as solid, but we've also had, and this was after the big revisions, how do you make that claim if we're just doing, I don't know, on average 35,000 jobs a month?
Well, there's two different, you're asking kind of two different questions. So let me go to both of them. First of all, when I say that the labor market is solid, which I think it still is, I'm looking at the state of the labor market. The unemployment rate, which is 4.2%, which is historically very low number. You look at other indicators of labor market strength, including from surveys of households, surveys of businesses, how easy is it to find a job, how hard is it to hire people. Those are also in I think in a solid labor market, and other indicators like quits and higher rates and things like that. So I think the state of the labor market is solid. We've definitely seen a slowdown in the pace of hiring in payroll growth, as you mentioned. I think some of that is really a slowdown in the supply of labor. As we all know, the labor force is growing more slowly now because of slower immigration, much slower immigration. So we're seeing slower supply and slower demand. And the hard thing to do is to figure out, well, is one slowing more than the other? The test of that is kind of the unemployment rate. The unemployment rate's been pretty steady, low fours, hasn't really changed over the last 12 months. Other indicators, I think, have, I would say, gently softened over the past year, but again, still a solid labor market.
Do you have a number or a range in your head of what the break-even rate is for it? In other words, how many jobs do we have to add each month in order to keep that unemployment rate steady?
Well, that's really hard to determine. I mean, there's a lot of estimates out there. In kind of more normal times, people talk, say, before the pandemic, maybe 100,000, 130,000 or something. Because of the changes in labor supply, that makes it very hard to know. When we had strong immigration a year or two ago, then we saw the break-evens clearly be much higher than usual. Now they're much lower. I don't have a good estimate. I think here is one of those times you have to, really show humility about the ability to understand what's happening exactly with labor supply. We don't have great real-time estimates of immigration flows. So I, again, look at these other indicators like the unemployment rate and others that are telling me kind of how that balance is looking. The final thing I'd like to say is, wage growth is a good indicator of the health of the labor market. Wage growth continues to be, I would say, consistent with a solid labor market and inflation coming down towards our 2% goal.